We have Stewart Heath with me here today, and you can learn more about what him and his team are up to by searching for Harvard Grace Capital. But I'm going to do everybody a favor and put that link in the show notes and make it clickable. So just click on through there. But it's Harvard Grace Capital. And Stewart and his team have a number of syndications that they run that acquire different properties, and it helps individuals on a passive nature accrue some wealth. But Stewart, I really appreciate your time here today.
I really appreciate you having me, Jack. It's quite an honor. Thank you for having me.
I'm always curious, Stewart. Everybody seems to get into syndication as in a step-by-step process. Did you start in single-family homes and move into multifamily syndications, or is that where you just jumped right in?
I guess I've always done everything a little bit at an accelerated pace. I started out with one duplex renting back in 2000, and then about 6 to 9 months later, I had 14, and then from there started building houses. Some of them built for rent, some of them built to sell, and then I started renovating condominiums, and just sprung up from there, and quickly, because I manage everything that we do, I quickly figured out that I don't really like residential housing. I'm not opposed to multifamily deals. We've not syndicated a multifamily deal yet. We do other types of commercial, a lot of which will follow on to the wave of multifamily, like storage and suburban office. But again, because we manage it, it's got to be a very special deal for us to do a multifamily deal. And besides, I think multifamily in most cases is really overpriced.
With that being said, you're doing primarily commercial deals. How does your portfolio stack right now? What are you focused on?
Our most recent acquisition was a self-storage facility in Huntsville, Alabama, and even that is a niche of storage. It's 125 units of large 1,000 square foot units targeted at RV and boat storage. And because of that, and because we're not renting trucks and selling boxes, we can operate very efficiently, and we don't have full-time staff dedicated to that one. It's pretty much remote managed, and it stays 100% full. Our other assets are, like I say, suburban office. Some people call that retail. It can go both ways. We're not doing glass front buildings or anything like that. We're doing office types that are all consumer facing. Insurance agents, mortgage companies, yoga studios. I got a Krav Maga studio, and they're all consumer facing, and they're all driven by the rooftops centered around that asset.
What drove you to focus on the commercial world? Was it the experience you had with the single family homes and the duplexes and the like?
There's something about me. I like the more longer term nature of it. When you build a relationship and you do the sale, and you convince somebody, you've made that sale for 3 to 5 years. And in case of medical people, sometimes 10 years. And if you do your lease correctly, like with proper cost reimbursements and escalators, then you've built a very nice piece of financial paper that's going to serve you without having to resell that every year. In multifamily, yeah, you have some tenants who will stay many years, but for the most part, they're in a year and a half and they're gone. And then you got to go in and fix it up. And most people are good tenants, but you're still going to have to repaint it, clean the carpets, and then you got to do the sale all over again. Now, that may not be that big of a lift these days. Multifamily is quite a bit. Yeah, it's very much in demand. But I like the efficiency and the long-term nature of the sale when it comes to commercial properties. Yeah, if I say that, the storage thing is almost the opposite of that. They're all kind of month-to-month leases. The the ease of management and the ease of moving people in and out it's a different animal. And I really like the storage with the remote management model because we're not running a retail business out of there. We're collecting rent and the ease to control your revenue. Yeah, it's pretty easy to raise your revenue up, and they do tend to stay a while. When you're renting to people, they got a $750,000 RV that they have to park somewhere. They're not that price sensitive.
It's interesting that you're picking those customer centric or those customer facing businesses. You were mentioning yoga studios and Krav Maga and a few other things. Have you seen any kind of change to that asset over the past couple of years because of the lockdowns and chaos that we went through?
Yeah, interestingly, that particular office asset we closed 13 months ago, closed on January 31st of last year. And raising money for that deal, as I talk to people across the country, depending on where they are, it's office. Are you crazy? And this particular asset I had managed for a client for 4 years. It was full. I already knew all the tenants. And to answer your question, no, there's not been a lot of change other than the rents are going up as we've had some tenant turnover. But so here's where I was going with that. We're in the South, and pretty much in the South since June of 2020, we've acted like there never was a pandemic. Everybody just went back to work and we did what we normally did. And that's been proven out, whether you're in Tennessee, Alabama, Florida. I guess Florida and Georgia were the leaders in that, of no restrictions. And even during the lockdown, the dentist still saw patients. We did not have a single tenant even have a single late payment. Now, the Krav Maga studio was absolutely hit the worst because it was not deemed essential. As there's a CPA firm, he has a small office, and that was tax season for them too. Yeah, they were going in and doing taxes. They had to. The home health people, they were essential. They have an office here and a training facility. They were deemed essential. Most of our people that were deemed essential or otherwise had reserves or PPP loans or whatnot to pay. So we fared very well. And in the intervening times, what really happened in a lot of cases in 2020 is when you did have commercial renewals, the tenants opted for shorter terms. So they said, I don't want to be locked in. So they might ask for a 2-year term if they were coming up for renewal, or a 3 versus a 5. And I said, sure, we can do that. And we did that with some people. But when you go the shorter term, you usually get a higher rate because the reason you go long is so you can lock in the rate. And now that we're coming out of some of those terms and we're feeding off of Nashville and I just wrote a lease for the biggest amount that we've ever dreamed of having here at $24 a foot, way here, 30 miles south of Nashville in a suburban office. And they thought it was a bargain. And as I look at the competition around, I'm still $3 below my competition, and I'm tickled pink with those rates. As people have moved in, moved out, and that's really talking about 2 tenants, because one of them is a church and they built a building, so everybody knew they were moving out. But as the market has increased, now I've locked in $24 a foot for 5 years in one case and 3 years for another. And I'm just tickled. I think it's all been very beneficial.
Earlier, you mentioned about the remote management for your storage units. Can you talk a little bit about that? What do
Yeah.
you do to manage those remotely?
There are a number of options of software that are available for storage management, as you might imagine. And by going to our website, you can reserve a space. Each tenant gets to set up their their own profile, which this is a process most of us are familiar with. So they can pay online, reserve online, send in requests online. They can schedule their end of lease online. And we encourage people to do that, but we do 12 hours a day. We do manned phones. And so we take a lot of phone calls as well. But the point is, we don't have to be on site. We have cameras everywhere. I can control the gate from anywhere. I can control the gate from my phone. Hey, my code's not working. We look and make sure they're not locked out for payment. And sometimes things happen with the gate. So I open the gate for them and me or my staff. And it's just a whole new world with technology. So we're really big property tech. And if technology can solve a problem and reduce head count, we're all for that. And not having any time staff it's a game changer because self-storage is incredibly profitable anyway. This facility is even more profitable because it's such a low operating cost.
I guess I haven't never talked to anybody about the software that is available for storage units. It sounds like you can get software to do automated wise on nearly anything. So if they, for example, you just mentioned, they get essentially locked out of their storage unit if they fall behind.
Yeah,
Just
so the
automate.
payments are due on the 1st. If it's like most rent, it's late after the 5th. So on the 6th day, the software just automatically turns off their gate code. If and then we start the calling process and stuff like that, and then most everybody gets caught up. By the 15th day, we can then go also lock them out of their unit, and doesn't happen that often. And when I say remote, it's not like we're never there.
Mhm.
I'm there. Our people are there at least twice a week for a couple of hours anyway. But yeah, that's a storage pretty standard operating procedure is when your payment's not kept current, then they pretty well lock you out.
Between the storage units and the commercial properties, how many properties do you currently manage or own?
We have 4 right now that we own and manage.
How many units are would that between the
How many tenants? That's being about 190 rentable units of various kinds.
sure. Do you have anything on the horizon, something that you're trying to possibly acquire next?
We have another, what we think is really attractive suburban office property in Madison, Alabama that we are pursuing. Another 100% full facility, all of them consumer facing business types. And we're excited about that one. I expect to sign that contract tomorrow.
Okay. You've mentioned Alabama and Tennessee so far. Is that primarily the markets you're in?
Yeah, we like to say our market is the 840 565 corridor. And what that refers to is 2 interstates. 840 is a loop around the southern end of Nashville, and 565 is a connector through the northern part of Alabama. And so we like to say we're investing in between those 2 interstates. And the other way to say that is the Tennessee River Valley. But the heartbeat of that area is Huntsville. As we talking right now, I'm in one of our assets in Spring Hill, Tennessee, south of Nashville. Because we property manage everything. So we want to look at anything we can get to within an hour. And so Huntsville's about an hour from here, vice versa. There's some great small towns that are also benefiting from the thriving Huntsville economy. And so there's some opportunities in places like Pulaski and Fayetteville that we look at from time to time. And those are type of markets that most investors will take a look at. We're not even talking secondary and tertiary markets. You're talking micro markets, but I don't know who said it first, but all real estate's local. And if what is going on the ground, then you can make a good investment.
If somebody came to you and asked, like, how do they get started with this? Would you advise the same thing, as to get very familiar with a local market?
That's what I would suggest. Now, I got a lot of friends in this business, and they have chosen to focus on a particular asset class. And I don't think that's the wrong approach. I am I am so focused on property management as it's really a loss leader if you want to. I think the property management model is broken in that the standard rates do not compensate good managers, and the only way they can make a decent living is by taking on more and more properties, which is a self-defeating purpose. We do that because that's our best way to deliver on the pro formas that we sold to our investors. Yes, I probably would recommend that to somebody else, but it's not the only way. I think you can get just as focused and learning about a particular asset class like multifamily, which there's a lot of specialty information to know about that. Or focusing on storage, there's again specialty information to know about that. So I think there's more than one way to come about the problem. But my opinion is what the way we're doing it is it's the right way for us, and it's the right way for us to deliver returns to our investors.
So just to remind everybody, head over to harvardgracecapital.com, and I'll make sure again to have that link in the show notes. And if you have found some value so far in this episode, can you do us a quick favor and share it with one of your investor friends? It would really help out the show. So, Stewart, I'm really curious as to what you think regarding, you've been in a couple different downturns now. I understand you experienced the 2008 downturn, and now we're in a economic flux, to say the least, at the moment. Do you see any similarities, and what was your experience in 2008?
In 2008, I was investing in real estate and doing all the wrong things. I was doing everything with debt. I was doing everything by myself, and I was leveraging one property to go buy another one. And so I was just maxed out on debt without regard to reserves. But for the lack of just reasonable reserves, I would have weathered the 2008 just fine because the assets were fine. We just needed a little bit of fallback money to last us a year or 18 months. But I didn't do that, and I paid for it dearly. Comparing 2008 to now, I don't see any similarities whatsoever. First, we have a very thriving job market. And when people have jobs, they spend money. Secondly, the banks are still actively lending. So here's a comparison. 2008, I did a personal financial statement for a bank as of June 30, 2008. And based upon appraisals and other third-party data, I had a net worth over $10 million. The next 90 days, by September 30th, a total financial meltdown had happened. John McCain had said to his opponent, Barack Obama, say, hey, let's leave the campaign trail and go back to Washington and fix this stuff. And Barack Obama said, good luck with that, and kept campaigning. But all the Lehman Brothers had failed, Bear Stearns had failed, a Countrywide Mortgage had failed, and they were sitting around figuring out how to pump liquidity into the system. And so banks had absolutely stopped lending in that 90-day period. And so I didn't pull another financial statement, couldn't afford the appraisals, but I assumed that I was then underwater $5 million. So a $15 million swing in 90 days. And it was all completely related to the availability of credit. If you know anything about real estate, the value of your real estate is completely connected to how much you can borrow on it. Because leverage always impacts asset values. And that's not happening now. There's plenty of money out there to be borrowed. Are standards higher? Yes. Are interest rates higher? Yes. Standards were not crazy a year ago when I financed a property for 10 years for 3.25%. The underwriting was easier. Cash flow coverage was easier because it was 3.25% interest. It was still limited to 75% loan to value. And so I don't feel like things got crazy. And so just the sheer raising of interest rates is not going to kill this market. It has slowed it down, which I believe is the Fed's intent here and trying to fight inflation. It has slowed it down. We're active in the market and we're cash flow buyers. And we almost don't care what the interest rate is. What we care about is the margin. We have over 1.2 times coverage of cash flow. And if there's enough margin there to pay a return to our investors and we can get it for that price, then we're in the game. Interest rates have gone up. They've also come back down a little bit. So no, sorry, that's a long answer to your question.
No.
I don't see any similarities between these two slowdowns.
With all of that experience, you probably have some advice for people when they're evaluating properties and maybe some things that they should avoid or some things that they should be looking for.
Yeah, underwriting is key no matter what the economic climate. I just alluded to our basic tenet that we're looking for. We want to, when we like a property, we want to be able to buy it and get a 1.2 times coverage on it and have enough cash flow to distribute a nice cash flow. That's when you're looking at a cash flowing property, which I think should be the basis of everybody's portfolio. I'm not against development deals or fix and flips or anything else. That is very different kind of deal, they all carry a whole lot more risk than what we are going after right now. And those are a lot of times good opportunities. The development and the fix and flip risk is you're buying now and you're betting on what the market will be 2 years down the road. When we're doing it, we are eliminating a lot of risk by dealing with stabilized properties, with locked in leases, and our only real risk is what happens to the tenant's business, yeah, as whatever economic factors, because we're going to have a fixed interest rate. We've locked in our income, and then we control the expenses as much as possible. But if you got good leases, most of your expenses are going to be sent back to your tenants anyway. So that's how we approach things and eliminate risk. If there's one piece of it, one thing I would suggest is when you're underwriting, make sure that you understand that after you purchase a piece of property, your taxes and your insurance are going up. They're not going to be the same thing that your seller was paying. It's going to happen pretty universally, and they're going to be based on the price you just paid. So make sure when you're doing your pro formas that you're increasing those two line items in calculating your projected cash.
Yeah. That was a painful mistake that we learned.
It usually only takes once.
There we go. Yeah, that was a painful lesson that we learned a while back. So I'm curious as to your opinion now, since you've had the experience in investing in single family, smaller properties, and now moving into the syndication world. Can you give people who are on the fence starting whether they should be doing this themselves like you originally did, or being involved in a project such as yours? What are some of the benefits? Compare and contrast a little bit between the two scenarios.
Yeah, if you have the desire to go out there and sponsor your own deals, heartedly applaud you. Go pursue your desire, and give me a holler. I'm happy to talk you through it. I'm old. Yeah, I've made a lot of mistakes, so I might can help you avoid some. If you don't have that desire at all, absolutely get involved passively, because anybody who's suffered through the stock market of the last year, that's not what investing is supposed to be. Investing is supposed to be putting money into reasonably stable assets that will generate cash flow and capital gains. And stocks can do that, but they're also subject to extreme fluctuations, as we've seen. And so if real estate sounds interesting to you, but you don't want to do it yourself, then absolutely pursue many of the options to invest in real estate passively. And the tax benefits, whether you're the sponsor or the passive investor, are massive tax benefits. 100% bonus depreciation is gone. Now we have 80% bonus depreciation, which is still pretty good considering from where I started in my early accounting career, when you used to get to write off half of a 30-year life in year one. So you get massive tax benefits up front. If your sponsor will do a cost segregation study, which we always do on ours, and that's reclassifying part of your property from real property to shorter life personal property, that enhances that tax benefit. You can take out cash through distributions somewhat on a tax-free basis, especially if you were able to refinance the property and send money back to your investors. That money comes back to you tax-free. So you can get cash and still have deductible losses. All of our investors are experiencing that right now. We're paying out on average about a 10% cash on cash return across our portfolio. And nobody's paying any tax on that because their tax benefits are outweighing that. Real estate, unless you sold in 2007, has always appreciated in value. It's not going to do a Facebook type of return, but it's not going to have a Facebook type of volatility either. I like to say real estate is the original asset class, and that Wall Street's done quite the number on us by calling it an alternative. As it's not an alternative, it's the original asset class. And it's been around since one caveman let another caveman use a cave. It's not rocket science anyway. I think if you're interested at all in investing, either as a sponsor or passively, absolutely pursue it.
So if you want to reach out to Stewart and his team to see how they can maybe help you with this, head over to capital.com. But Stewart, this has been a great conversation so far, and I warned you that what's coming, but I was hoping to hit you up on some rapid fire
Sure.
questions here now. First of all, is there a real estate investing myth you'd like to bust here today?
Yeah, real estate investing myth is if you're going to make money in real estate, you have to be willing to get up at all hours of the night and go take care of somebody else's toilet. That's not true. Somebody might have to, but most of the money you can make in real estate has nothing to do with doing the duties that the property manager will.
What book would you recommend, or what are you reading right now?
I realize that Rich Dad Poor Dad is off the limits, but so I recommend that one. But one of my favorites is Dan Sullivan's Who Not How. I think I got the author right, and it's more from an entrepreneurial point of view, as that we entrepreneurs, we want to do everything, and this book encourages us to not do that and to find the right person to do whatever needs to be done.
What was your biggest real estate investing mistake or business, and what did you learn from it?
Mentioned that earlier, is going into these properties back in 06, 07 without the proper reserves. And it worked for several years. And the whole world thought the tide would never go out, but it did. But for the lack of about 300,000, maybe 500,000 of reserves, I could have saved a $10 million net worth.
That's one of the things that has been propagated throughout our real estate industry, or guruship, if you will, for a long time, is leverage acquire as much as possible, as quickly as possible.
Yep.
So
some really smart people gave me all that advice and pursued it to the max.
if you could go back in time and give your younger self one piece of advice, what would that be?
Go slower. Go slower.
Yeah. That's the opposite of everybody I've ever had on the show.
Really?
Yeah. Most want to go faster or start earlier or both. It's never be more cautious or be a little slower at it.
Be a little more. Yeah, I get it. And right now, I have plans for this year and I want to go faster. I haven't really changed who I am, but I made some mistakes. And the faster you go, the faster you will make your mistakes. So if
Right.
you're being prudent and you have good systems, once you have good foundation, then you can go fast. So I had never laid the proper foundation.
This is the only one I'm going to time you on. You have exactly 60 seconds, and you have to give everybody one tip, trick, advice that they can implement in their business today to have a direct impact. What would it be?
Speak one-on-one with all of your people, deepen those relationships, and try to build real trust. If you cannot get there, then you need to change in that team, whether these are contractors or employees, but be very directly involved relationally. And it doesn't mean go in there and micromanage them and whatever they're doing, but be very relational with everyone on your team. That would be my tip for
No,
them.
great piece of advice. Stewart, is there a question or concept you wish we would have covered here today?
I'd like to talk sometime about the benefits of investing in real estate in inflationary times. I think the math and economics there are very interesting and fascinating, but it's a show all to its own. And
Yeah.
maybe it gets my inner geek going on because you get to talk about some really high level economic type things, but it's a real thing. There's a real benefit to it.
Everybody can hold tight for part 2 then.
That's great. Love to.
So it was great chatting with you. Great meeting you, Stewart. And again, it is harvardgrade.com. Thanks, and we'll talk to you soon.
Thank you so much. Appreciate you having me.